then we will start. Okay. So we will solve one problem. And before we solve this problem, we will also do the revision. Now, JK Limited has furnished the following information. So look at this problem. This is slightly different from whatever you had done earlier. So what it is saying, standard overhead absorption rate 20. So this is per unit. Then standard rate per hour. Standard rate per hour. Budgeted production 12,000 units. Actual production 15,560 units. So these are the budgeted and actual data in terms of units. Then actual overhead were 2,95,000, out of which 62,500 is fixed. So you have not seen this kind of problem earlier. You were getting either fixed overhead or you were getting either variable overhead. In this problem, you have actual overhead, out of which 62,500 is fixed. Then actual hour is given. After that, there is a small table. This is the table. What is given? Overhead are based on the following flexible budget. So here at this point, you should be clear about what is flexible budget. So in paper 8 also you have solved some flexible budget. If production is so many units at 50% capacity, what will be the production at 80% capacity? Like this. So this is the behavior of flexible budget, which have both fixed and variable component. Then they have asked required with detailed working note and on hourly basis, calculate standard variable overhead and fixed overhead rates per hour. So in the first sub question, nothing about the variances. Then calculate variable overhead efficiency and expenditure variance. So second question is about variable. And third question is calculate fixed overhead efficiency and capacity variance. Again, the third question is fixed. So this question is actually beautifully framed. It will not check whether you remember fixed overhead or variable overhead variances formula. It tests whether you know the entire concept of variable, fixed, then standard costing. So it encompasses everything. So before we start this question, we will do one small revision about what we learned yesterday. Okay, so we have first one, fixed overhead cost variance, which is the topmost one. It has two subvariances. On the right side, you have fixed overhead expenditure variance. Then on the right side, you have fixed overhead volume variance. So the formula for fixed overhead cost variance, the topmost, is absorbed overhead minus actual overhead. So this considers only fixed overhead. So the formula for absorbed overhead is standard hour into standard rate. And similarly, actual overhead formula is actual hour into actual rate. Now let's come to the expenditure variance. Expenditure variance is the difference between budgeted overhead minus actual overhead. So the formula for this will be budgeted hour at standard rate minus actual hour at actual rate. Left hand side we have factory overhead volume variance. This is the difference between absorbed overhead minus budgeted overhead. So now absorbed overhead formula I already know. Standard hour at standard rate and budgeted overhead is budgeted hour at standard rate. Now this volume variance has further two subvariances. You have capacity variance, then you have efficiency variance. efficiency variance formula is the difference between hours, standard hour minus actual hours worked at standard rate. And capacity variance is the difference between actual hour worked minus budgeted hour at standard rate. So capacity variance can have two subvariances. One is due to calendar. If the number of days were different in that month, so the calendar variance will come into picture. This is revised budgeted hour minus budgeted hour at standard rate. And you also have revised capacity variance. So this is the difference between standard hour and revised budgeted hour at standard rate. Now in any of this problem, the suggested approach is you make factor table. First one is SHSR, second one is VHSR, so second one is VHSR, third one is RBHSR, fourth one is AHSR, and fifth one is AHAR. So in the fourth one, this is the actual hour worked. How to remember this? So the rate factor in 1, 2, 3, 4 is always standard rate. Only in the fifth one, it is the actual rate. Then we will stand with hours. We will start with budgeted hours. Standard hours, then budgeted hours, revised budgeted hours, actual hours worked, then actual hours. Now let us map the formula to our chart. What is factory overhead cost variance? It is 1 minus 5. Next, what is my expenditure variance? This is my 2 minus 5. Then volume variance, 2 minus 5. Expenditure variance is BHSR minus AHAR. BHSR is 2, AHAR is 5. Next is the volume variance. Volume variance is 1 minus 2. SHSR is 1 and BHSR is 2. Next, subvariances of budget volume variance, capacity and efficiency. Efficiency is given by 1 minus 4 and capacity is given by 4 minus 2. Calendar variance is given by 3 minus 2 and revised capacity variance is given by 1 minus 3. Actually, we have not seen any question on revised capacity variance so far, but calendar variance is actually asked everywhere. And the previous question is asking about variable overhead also. So let's also revise variable overhead. So variable overhead on top, you have variable overhead cost variance. Then you have 2. On the right hand side, you have expenditure variance. And on the right, you have efficiency variance. Correct? So the efficiency variance, it is the same formula. SH minus actual hour worked at standard rate. And expenditure variance is also called as rate variance. So the variance is because of rate. Standard rate minus actual rate into actual hours. Now let us go back and see the question again. So in the question, they have given standard overhead absorption rate is 20. So that means, since this is a question which involves both variable and fixed overhead, this standard absorption rate also includes both components. That is hidden. So unless you know the basics and why this table is given, if you don't analyze, you will miss it. Then standard rate per hour is also 4. This also includes both variable and fixed component. Budgeted production, actual production, all this data now we will use. First we will find out what they are asking as part of their question number 1. Calculate standard variable overhead, fixed overhead rates per hour. So this is what is asked. So the moment this is asked, you should understand that this 20 and this 4 comprises both fixed and variable components. Now, how to go about this? How can I calculate? So again, this is your paper 8 question where you have to segregate your variable and fixed cost. How will you calculate what is the variable cost per unit? Using this formula. Variable cost per unit is given by change in cost divided by change in units. Similarly, variable cost per hour is given by change in cost divided by change in hours. So using this formula, you will be able to find out what are the variable and fixed component. Now let us see. Standard overhead absorption rate per unit is 20. Then standard rate per hour is 4. So using extrapolation, we will understand what data is given. So 1 unit is equal to 20 rupee. Okay. Then 1 hour is equal to 4 rupee. When I use these two data together, what do I get? So I will divide, let's call this equation 1, let's call this equation 2. When I divide 1 by 2, what I will get? I will get 1 hour or unit per hour will be 5. So unit divided by hour, on the left hand side I have unit per hour is equal to 5. So this is a crucial information. That means I will get 5 units in 1 hour. Now use this table. Let us use this table. Take any 2 period data. Okay. So I have, let's consider this and this. On the numerator, I have difference in cost, which is difference between these two. 2.1 and 1.8 lakh. So variable cost per hour minus 180 divided by. Now I have units I have to take now, right? Now if I take per unit, I will get variable cost per unit. But what I need variable cost per hour. Means I need the standard rate. Variable cost standard rate I want. So to do that, I will have to take hours in the denominator. So I have to convert this 8,000 and 10,000 into hours. How many hours they are taking? Understood? You are getting the conversions. This is important. Now, how many hours will it take? Units per hour is 5. So I have got units per hour, which is 5. So that means 8,000 into 5 divided by 10,000 into 5. So 40,000, or I'll write 50,000 only. 50,000 minus 40,000. So this will give me numerator difference is 30,000 and denominator difference is 10,000. I will get 3 per hour. So my standard rate for variable is 3. And what does the question say? Standard rate per hour is 4. So out of 4, 3 is variable. That means my standard rate of fixed overhead is equal to 1. So total is my standard rate. So my first question is answered now. Now next, let's go to, do you have any questions on this so far? So this is a very beautiful question. Next, calculate variable overhead efficiency and expenditure variance. So what is the variable overhead expenditure variance formula? Standard rate minus actual rate into actual hours. Or we can also expand this formula, right? SR into AH minus AR into AH. I will expand this formula. Always AR into AH is actual overhead. Even in fixed or in variable, AR AH is always the fixed actual overhead, and SR into SH is the absorbed overhead. Now let's go back and see what is the actual overhead. So actual overhead were 2,95,000, out of which 62,500 is fixed. Now I am calculating variable overhead. So that means I will subtract the fixed component. 2,95,000 minus 62.5. I will get 2,32,500. So 2,32,500. Then minus SR variable. So I know it is 3. Then actual hours. Actual hour is 74,000. So I will multiply 74,000. So I'll get 10,500 adverse. Similarly, now I will have to calculate efficiency variance. In this standard hour, I have to calculate first. Okay, what is my standard hour? Or I can also take standard hour, whether it is given in the question. No. Standard hour I will have to calculate using actual production and standard rate, standard hours per unit. So standard hours per unit, how many standard hours I will get? Five, not 4. We have calculated, no? Just now we had calculated. This one, 5. So standard hour 15,560 into 5. And actual hour is given 74,000. into standard rate. Standard rate variable is 3. This is 77,800 minus 74,000 into 3. So it is 11,400 favorable. So they have not asked anything about what is the overall cost variance. So we need not find in this problem. So we have solved the second sub question. What did we solve? First we found the standard rate. Then in that, whatever is applicable for only for variable overhead we have taken, that is 3. And all other things we have just substituted in the equation. Similarly, now we have to calculate the third question. So here it is calculate fixed overhead efficiency and capacity variance. So efficiency is the same formula. Whatever you used for a variable overhead, for fixed overhead also it is the same formula. But in this formula, your standard rate is not 3, it is 1. So in this you have to use this formula. But the standard rate, you should not use 4 or 3. This is under fixed. So I have to take 1. Standard rate is 1. Standard hours, we have already calculated 77,800. And actual hour is also given 74,000. So fixed overhead efficiency variance is equal to SH minus AHW into SR. So this is equal to 77,800 minus 74,000 into 1. This is equal to 3,800 favorable. Okay. Next, along with efficiency, also have to use capacity variance. And the formula for capacity variance is actual hour worked minus budgeted hour. Let us look at the formula. So actual hour worked minus budgeted hour. Now what is the budgeted hour? Budgeted production is 12,000 units and each unit takes 5 hours. So that is 60,000. Budgeted factory overhead, fixed overhead capacity variance, actual hour worked minus budgeted hour into standard rate. So budgeted hour is equal to 12,000 units into 5, 60,000 hours. Actual hour worked is 74,000 minus 60,000 into standard rate fixed 1. So this is equal to 14,000 favorable. Clear? Any other doubts? So this means your conversion to standard unit per hour, standard rate per hour, this is very important. Can we proceed to the next question? Next question. Thus, GEMS Limited provided you the following data for the month of March 2023. So the data is for a month. Fixed overhead, units produced, hours per unit, number of days. This data is given. You are required to calculate all the variances. Fine. So this is a straightforward question. So that means you should start identifying whatever data is given. So let us first write our table. That will give us an easy understanding what is there or what is not there. So first one is SHSR, then BHSR, RBHSR, actual hour worked and standard rate, then AHAR. So typically in your question, actual overhead and budgeted overhead are usually given. That means AHAR and BHSR are typically given. So this is your standard or budgeted data, 30,000. This is BHSR. Actual overhead is AHAR. Direct we can write these two here, 30,000, 35,000. Next, I have to calculate standard hours. How to calculate standard hour? For that, I should know what is the standard hours per unit. So standard hour per unit is given. It is 1. So standard hours for 1200 units will be 12,000 hours. So therefore SH is equal to 1200. 1200. And what is my standard rate? So to calculate my standard rate, I know what is my BHSR. BHSR is equal to 30,000. So therefore SR is equal to 30,000 divided by budgeted hours. What is budgeted hour? 1000 into 1. No, standard hour is 1200. Budgeted hour, you have to consider budgeted units and multiply it with hour per unit. So budgeted hour is 1000. So that means standard rate is going to be 30 per hour. So now I have standard hour and standard rate. I can calculate SHSR, which is 36,000. So I'll write 36,000. All this you have to write as a working notes. Then revised budgeted hours. Can I calculate? Yes, I can calculate because there is a change in the number of calendar days. So revised budgeted hours is equal to budgeted hour into 23 divided by 20. So budgeted hour was 1000. 1000 was the budgeted hour into 23 divided by 20. 1150. RBH into SR I can do 1150 into 30. 34,500. So this is 34,500. Now what is my actual hour worked? My actual hours per unit is given 1.1 and actual units produced is 1200. So 1200 into 1.1 is my actual hours worked. Actual hours worked is equal to 1200 into 1.1, 1320. Now 1320 into standard rate, 39,600. So 39,600. Now my job is easy. So fixed overhead cost variance. What is my cost variance? 1 minus 5. So 36,000 minus 35,000. That means 1,000 favorable. This is my first variance. Second variance, fixed overhead expenditure variance. 2 minus 5. This is equal to 30,000 minus 35,000. So minus 5,000. Third one, fixed overhead volume variance. So volume means it is because of actual standard hour and budgeted hour. So the formula for this is 1 minus 2. 6,000 favorable. At this point, I should reconcile. Minus 5,000 plus 6,000. I should get overall cost variance. 1,000 favorable. So all these three are correct. Next, fourth one, capacity. Fixed overhead capacity variance. So this is AHW minus BH. 4 minus 2. 39,600 minus 3,000. So 9,600 favorable. Fifth one, fixed overhead efficiency variance SH minus AHW. So 1 minus 4. 3,600 adverse. Now shall I reconcile here these two? Plus 9,600 plus minus 3,600 is 6,000. This is correct. Last one, calendar variance. Calendar variance is RBH minus BH. That means 3 minus 2. $4,500 favorable. Seventh one also will calculate. Factory overhead revised capacity variance. So SH minus RBH. That means 1 minus 3. 1 minus 3,500 favorable. What else is asked? So they have asked idle time variance. Now, idle time. What is idle time? Idle time is equal to actual hours minus actual hours worked. So in this question, can I calculate actual hours and actual hours worked? This is what I have to find out. Is there a idle time? If there is no idle time, then idle time variance is 0. So fixed overhead is 35,000. Then units produced is 1,200 and hours per unit is 1.1. There is no mention of what is the actual hour or what is the idle time or what is the actual hour worked. So if I divide 35,000 divided by 1.1, I'm not getting any data. 35,000 divided by 1,200. In this question, it is not possible to find out what is the idle time. So I think we can mention this as 0, or if there is any method we can find idle time. At least as per your syllabus, they have not taught you how to calculate the idle time. So now, whether we are reconciling everything, yeah, everything is getting reconciled. So first step important, standard hour you should be calculating, standard rate if not given you should be calculating, then budgeted hours, budgeted units, revised budgeted hour if there are calendar variations, and actual hour and actual hour worked. If that is mentioned, idle time also will come into picture. Otherwise, no need to worry. So that is all on the fixed overhead variances. So you have 7 variances. You have direct formula method, or you have the chart method, or the shortcut method. Whichever works for you, you can use it. I suggest you just try to find out more standard hour, standard rate, because that is where you will definitely get stuck. Once you know that, then other things you can calculate.